December 13th meeting of the Santa Barbara City Finance Committee, and we only have one item on the agenda. There is nobody in the audience, so we do not have anyone who is here for public comment on items that are not on the agenda. Actually, now we do have someone. So this is an opportunity for folks to comment on items that are not on the agenda. And seeing no one, we'll continue with the single item, which is the comprehensive annual financial report for the fiscal year ended June 30th, 2016. Mr. Samario?
Yep. Thank you, Mr. Chair, members of the committee. Bob Samario, Finance Director. So I'm just going to make a couple of comments and turn it over to Jennifer Tomaszewski. She's our accounting manager. And you've met Rich Kikuchi. He's the partner with Lance Saul Longhard, the CPA firm we have that does our audit. I wanted just to mention that you can see in front of you, it's a pretty good-sized document. We think it's important, and it is, in fact, a very important document we do every year. It doesn't have or get the notoriety that our budget document gets because it's not forward-looking. This is looking back, and it's looking at how we did last year, and it's 5 months, after the year end. So some people think it's a little, later than it should be, but it takes that much time to put this document together. I will say that the process starts in July and it goes all the way to now, with closing the books, getting ready for the audit, working with the auditors during that period of time that they're here, and then producing this document. And it's a lot of time and effort. Jennifer Tomaszewski, this is her second time doing this. She's only been with the city about 15 months, and she's done a tremendous job in making sure this is done on time and it's done efficiently and without a lot of drama. And because this could be, there's a lot of stress involved in putting this together, hard deadlines we have to meet in order for this to be here in December. And I'm sure she'll mention her staff, but Lynn Sparks actually is here. She's our accounting supervisor, and she is very instrumental in putting this together. So anyway, I just wanted to recognize the amount of work required to put this together and to recognize their work. And with that, I'll turn it over to Ms. Tomaszewski.
Good afternoon, Chair Hart, committee members. I am Jennifer Tomaszewski. I am the accounting manager for the finance department, and as Mr. Samario stated, I will be going over the comprehensive annual financial report, or as we call it, the CAFR, for fiscal year 2016. So I will be going over some background information on the CAFR, some of the layout and contents of the report, some financial highlights, some key footnote disclosures, and then I will hand it over to Mr. Kikuchi to go over the audit itself. So first off, what is the CAFR? It's an annual financial report prepared in accordance with nationally recognized accounting and financial reporting standards, or according to GAAP accounting. It presents the financial condition and the results of operations of the city as a whole, and also for individual funds. It's comprehensive because it includes information that's not required by financial reporting regulations, which allows it to qualify for the GFOA award program. And we did receive that last year, and it was the 13th year in a row we've received that award. So we're going for year number 14 now. Hopefully, knock on wood. So it also provides the reader with more information about the city's finances. So why is the CAFR prepared? It's prepared because it's, the city charter requires the preparation of an annual financial report that is audited by an independent CPA. It's required by state law. Bond rating agencies use them to determine credit risk and to set interest rates, and it provides important information about the city's finances to the public. Sure.
You might recall we just sold some bonds this past week, or we're about to sell them, but we got approval from council to do so for the wastewater fund, refinancing some debt. And the CAFR is very important. They look at our CAFR, and it's a measure of our financial health, and therefore the risk we are to the investors. And, it shows reserve balances and all that. But it's an important document in that regard. So they looked at that document primarily as a way to measure what kind of financial condition we're in, and looking at individual funds like wastewater or water that are issuing debt. So it came in very handy this year.
So next we're going to look at the contents and the layout of the report. There are 3 sections to the CAFR, the first being the the introductory section, which is unaudited, and it's comprised of the letter of transmittal. This is prepared by the finance director and the city administrator, and it provides information about the city as well as about the CAFR. And then there's also supplemental information such as the organizational charts, boards, commissions, the prior year GFOA, and then the next section is the financial section, and this is the portion of the report that's covered under the audit opinion. And Mr. Kikuchi will be going over the independent auditor's report. Next, the MD&A. This is a comparative analysis from fiscal year 15 to fiscal year 16. And basically, it's a narrative that helps give some perspective to the activity that happened throughout the year. The next item is the basic financial statements. This will be where we spend most of the conversation today. And then the notes that also support the financial statements. And then the last section is the statistical section, and that is also unaudited. And this gives 10-year financial trend information, so it helps put some context to the information you see in the report to show trends over time. And it also provides various financial and demographic information. So some financial highlights. So we are also going to talk about some of the impacts of recent GASB pronouncements. We're going to look at some of the government-wide statements and the individual fund statements, and then some key footnote disclosures. So as far as impacts of GASB pronouncements, the main change in the last couple years has been GASB Statement Number 68, which relates to accounting and financial reporting for pensions. This was adopted in 2012, but actually took effect last year, and there were 3 key changes to that. First, the unfunded portion of pension obligations are now reported as the net pension liability on the financial statements rather than just a footnote disclosure. And it also, another change is the net pension liability is also reported as total liabilities minus the fair value as opposed to the actuarial value. Actuarial value tends to be a little bit slower to react to the market. You look like you're ready to jump in. Okay. And then additional required disclosures. We went from about 4 pages of footnotes to about 11 and a half. So there's a lot more information in the body of the report.
So this is a pretty big deal. You know, every once in a while, GASB comes up with, some pronouncement that has a meaningful or substantial impact. This is a big deal because this is about the unfunded liabilities that agencies across the state have, and the nation too. But for us, we're part of PERS, and we are not unique in that we have a large unfunded liability. And GASB, sort of migrated from additional disclosures in the footnotes to finally saying, it's not getting enough press, not getting enough recognition. So we are now requiring that, or they're requiring that we actually include that as a liability in the financial statements. So it's like whether we have bonds outstanding, now this is one of those liabilities. And it's big. For some cities, it puts them sort of upside down. But it's now on the face of the financial statements versus just a disclosure. So this is significant, and we'll talk more about those numbers, but just wanted you to appreciate the significance of this pronouncement.
Okay, so now we're going to go into the government-wide financial statements. And in the CAFR, we report on a government-wide basis and then an individual fund financials. And just to explain what government-wide financial statements are, back in 2001, GASB 34 was implemented, and that required agencies to report on an accrual basis, showing all assets and liabilities. And the purpose was to have agencies present financial information as a whole in a manner similar to the private sector, whereas fund financial statements have a more short-term focus. So first we're going to look at the government-wide. And what we see here, this is the government-wide statement of net position. You can see this on page 28 of your CAFR report. And again, this is full accrual reporting. And the purpose is to identify the financial condition of the city as a whole, as I stated, and to show the overall health of the city at a point in time, in this case, June 30th, 2016. It's broken into two categories. We have our governmental activities and our business type activities. Governmental activities, these are the programs associated with traditional local government and supported by general revenues, taxes, franchise fees, so forth. And these would include the general fund, affordable housing, special revenue funds, and internal service funds. Whereas the business type activities, these are going to be the enterprise funds, and they rely primarily on user fees and charges to fund their operations. So those are the two main differences. In this first section, we see that the total assets for the city at the end of the year were about 1.2 million, or billion, sorry. And below that, you see deferred outflows of resources. Those are similar to assets. Next, we have liabilities, and what you see here is about 492 million, and more than half of that you'll see in the middle line, the net pension liability. Here's the effects of GASB 68 right here. So you see that 250 million relates to now putting that total net pension liability on the books. And then below that, you see deferred inflows of resources. Those are similar to liabilities. And then in the bottom, the net position, we actually have three categories here. So this is basically the assets minus the liabilities for a net position of about 733 million. And of those three categories, the first and the largest being the net investment in capital assets. So this is all the city assets minus any accumulated depreciation and any long-term debt associated with either purchasing or constructing those assets. And then the second section, the restricted, these are items that are restricted by external sources such as grantors, contributors, or by law or regulation. And of that 93 million, about 52 million of that is related to affordable housing. So, and then the last section is unrestricted. And again, what you'll see here is this is actually in a negative. This is a negative 149 million, also as a result of having to now book the net pension liability. So if you back out that net pension liability, the unrestricted net assets or net position would be about 101.4 million. So that is the statement of net position. Does anybody have any questions
Yes,
before I go
Councilmember
on?
Dominguez has a question.
How does GASB define net pension liability?
So it's the total actuarial accrued liability minus the fair value of any assets. It's basically the unfunded portion. It's a little bit more complicated in that it takes into account deferred inflows and outflows, and but for the most part, it's basically the difference. It's the unfunded portion.
And in terms of a working definition, would this be what we're going to owe down the line for current and past employees that's not being funded currently, or?
Correct.
So, because I know this is an accrual definition, but does it map out to a cash flow definition, or is that too hard to map out?
Yeah, that's a great question, Committee Member Dominguez. It's probably more on a cash basis. What PERS does is they sort of come out with a funding strategy or plan that says we will fund this the person's obligation, pension obligation, during the course of their employment. And they basically said, okay, here's the path. Every year we're going to have to accumulate so much money, and they convert that to a percentage of payroll. But it's a funding path that, if all the assumptions hold true, they'll get to a fully funded status by the time the employee retires. And so the accrued liability at any given point in time is, are we on track with what we're supposed to have along that funding curve? So if we're halfway through, we should have half of the amount of money accrued or built up. And so they compared that number to what we actually have in the bank and with PERS in terms of accumulated assets, and that difference becomes the unfunded liability.
So the accrued liability is their predicted lifespan. That's the actuarial component times what their pension payout will be,
right?
Minus, so the asset would be what they've put in, what we've contributed up until then. Okay.
Right.
Great, thanks.
Councilmember White.
Thank you, Mr. Chair. And so what's there's the percent rides along in that, and maybe that's in here. What is that percent? We're going to hear that later?
Yeah, that's
Okay.
coming up.
Okay,
Okay.
thank you.
Okay. So the next slide, this represents the statement of activities. And again, for this discussion, we're looking at the governmental activities. On the next slide, we'll look at the business type activities. But the purpose of this is to identify how the financial position changed over the year. And the other purpose is to identify what governmental activities are being subsidized by those general revenues. So for example, we look at the public safety program, and we see public safety cost about $63.5 million, and it generated program revenues of about $14 million for a net deficit of about $49 million. That $49 million represents about 78% of the cost of all those public safety programs, which are subsidized through the general revenues, taxes, franchise fees, so forth. Whereas, like community services, it was supplemented about $11.5 million, so that's about 44% of their program costs. So the net deficit being $72 million was offset, I'm getting a little ahead of myself, by general revenues of about $121 million, which you see below. And the net change for the year in net position is about $49 million. Now, this is a little bit higher than we would typically see, and the largest portion of that you'll see right above is the extraordinary items. This $23 million represents the final transfer from the successor agency to the city, and for Paseo Nuevo and Railroad Depot, I believe. And there was some small amount of, it's mostly land, but there were some small, not fully depreciated improvements as well. But we would not typically see that.
So a very unusual presentation, that this is trying to sort of say how much do each of these functions require by way of subsidy from taxes, essentially. GASB felt that was important. It probably is. I mean, it's more intuitive. You would expect that public safety is not out there trying to generate revenue through fees, that they just sort of fight fires and safety to our community. And so therefore they would be highly subsidized from taxes, and you can see that's demonstrated here. So that's kind of the idea. Administration you would expect to be subsidized substantially because it doesn't generate fees. But overall, about half of our costs are subsidized through revenues, and half of them are recovered through fees, which isn't bad.
Any more questions before I continue? Okay. So on the next slide, it's going to be the same format, except these are the business type activities. And in contrast, what you see here is the expenses for the year were about $118 million compared to revenues of about $133 million. So you see these operations were supported by the program revenues. And there was a little bit of I can't say that word, anomaly in water, but we'll look at water on a subsequent slide as well. But water was the main contributor to that increase to the net position. So again, the net surplus at the end of the year for the programs were a little less than $16 million. And then when you look at the general revenues, those are obviously much smaller than in the governmental activities, and mainly investment income, for a total change in net position of a little less than $17 million.
So you hear a different story because the enterprise funds essentially aren't covered by any taxes, or there's no subsidy going on. Everything they do has to be recovered from fees, so that you can see they actually generated a surplus in almost all cases, because that's what helps them fund their capital programs and the like. So their expenses are operating expenses, and then they generate surpluses for capital purposes. But clearly, unlike the government activities, they're recovering all their costs from fees and charges to the users.
So next, we are going to look at the individual fund financial statements. And again, these represent a more short-term focus, and they're reported on a modified accrual basis. So they don't include capital assets or long-term debt. The city has many individual funds for this presentation. We're only going to be looking at a few of them. First, we're going to look at the general fund. And so what we see here, again, no capital assets or long-term debt. And in total, the assets were about $45 million compared to liabilities of about $9.3 million for a total fund balance of about $35.9 million. And fund balance is actually broken into 4 different categories. So non-spendable, that $2.7 million, that's going to be tied to loans receivable and advances, whereas restricted, these are going to be external restrictions by creditors or grantors. Those are mainly going to be encumbrances. And then the largest amount that we see here are the committed. And these are amounts constrained by formal action by City Council. These are our policy reserves. These are going to be our contingency and disaster reserves. And then a small amount to assigned. Assigned, these are amounts constrained to be used for specific purpose as designated by the city administrator or the finance director. And these typically include carry forwards, appropriation carry forwards. Sorry about that. What this shows is that the general fund is in good condition. And again, for fiscal year 16, at the end of the year, policy reserves are still fully funded. So on this next slide, we look at the general fund final results. So here, this is basically the budget to actual comparison. And we have gone through these. I think we went through the preliminary results in the fourth quarter report. But what we see here is revenues, including transfers, were budgeted to come in about $127 million, with expenditures estimated to be a little over $28.5 million. So when we created the budget, we anticipated a deficit to be funded through reserves. For capital? Okay. But what actually happened is revenues came in slightly higher than expenditures for a surplus of about $2.7 million. So even though revenues were down $5.2 million, expenditures were down even more than that, $9.3 million. So this created a budget to actual variance of about $4 million. Now, this does not include the 25% surplus that we normally transfer at year end to fund future capital. That went in the first quarter of this year. So if we were to put that into this number, it'd be about a little less than $3.5 million results. So any questions before I move on from the general fund?
Councilmember Dominguez.
Thank you. The excess figure here, the negative $1.4 million. Now, is that because we had adjusted the budget through the year that we have a negative, that we have a deficit as opposed to a balanced or?
Well, this included our revised budget, but we could potentially have an original budget that would be backwards, that, or, have a deficit situation if it was estimated to use reserves.
I think what happens is, and I may have misspoke, so I'm assuming the expenditures here include capital, the transfers. So,
yes.
So that $1.3 million represents the fact that when at the beginning of the year, one of the first things we do is we carry over appropriations from the prior year that are unspent, that is authorized projects and capital and those kinds of things. And that immediately sort of creates a negative or a deficit or use of reserves. We set that aside at the end of the prior year, but when it gets carried forward, it looks like it's a use of reserves, but it's already kind of been earmarked. So it's just the nature of those carryovers that automatically puts us out of balance because the appropriations come forward, but there's no funding source other than reserves to pay for them.
And these numbers are back to a cash flow system?
Yeah.
So then the other question, just going back to the previous slides, where is the reserve reflected? So on page 28, under current assets, would the reserves be in the pooled cash and investments?
Committee Member Dominguez, that's true. So you look at the assets above. Generally speaking, it's the cash and investments of 27, but we don't really look at it that way. I mean, it's essentially what it is. But the fund balance, the bottom third, represents the difference between assets and liabilities. So our total fund balance is $45.2 million minus 9.2. And then we parse it out into its various components, and one of those is the reserves. So, arguably, it's the reserve balances is a combination of all the assets minus all the liabilities into a net number that is allocated toward those reserves. But largely, it's really made up because the assets is the biggest number. I mean, cash and investments is the biggest number up there. Of course, that's the biggest driver.
Great, thank you.
Sorry, I have to go back through all my little circles here. Okay, so next we're going to look at the water fund. With the drought, we figured it would be, a good fund to point out and go through, given the drought. So this slide shows the final results for the water funds. So again, we see the numbers are going to be close to how they were reported in the governmental or in the government-wide. There are different journal entries that happen, but I mean they're close for this discussion. So we see that the water fund brought in about $45.3 million in revenues, compared to about $34 million in expenditures. And then we also include some non-operating items such as an interest, capital contributions for an estimated change in net position about $11.5 million. And to put some context to this, if we were to look at this slide from last year, we would have seen that operating revenues were down. They were about $35 million compared to operating expenses of about $41 million. So it was upside down last year. So at that time, rates were increased to compensate for those deficits. In the next slide, we're going to look at the reserves to put some context to this $11 million. And then what happened this year is the rates were increased, and then the operating expenses actually, there were some savings throughout the year that weren't anticipated when our public works staff hadn't anticipated. There was a savings from, I think we received about a $2 million credit from the water purchases for a true-up from the prior year. There were a lot of things that happened, but their water operating costs were much lower than they had originally expected. So that created this $11.5 million surplus. But to put some context to this, when you look at the reserves, the first section is the policy reserves, and that's really just for your information to see the makeup of the policy reserves for water. So in fiscal year 15, those reserves were a little over $18 million. And then in 16, they were a little less, so, a reduction of a little less than $500,000. But the important thing to look at here is the bottom half of this slide. So in 15, we see the effects of being upside down and the revenues coming in much lower than the expenses. And the change in that, the $9.3 million, that's the main part of that $11.5 million that we looked at on the last slide. It's not just the $11.5 million goes straight into reserves. There's some carry forwards and other categories that some of that went to. But for the most part, here's the effects of that. So we see 15 was upside down about $5.8 million in their available reserves in fiscal year 15. And at the end of 16, they were in a surplus situation for available reserves of about $3.5 million. But this doesn't mean that water's quite out of the woods, because if you look at their 17 budget, they had actually anticipated a little over $7.5 million of reserves to fund this year. So Public Works staff is aware of this, and they're actively looking at their options for funding their water activities. but we just wanted to put some context to that. So is there any questions on this before I move on?
I just wanted to point out, to me, this is good news. We were surprised to see the extent of the surplus, $7 million going into reserves. We didn't expect that. Revenues we thought would be a lot less, and they came in almost at budget. But it's really on the expenditure side that things just helped us, because we were having to look at rate increases that only included additional costs for desal and those kinds of things, but having to make up for those reserves. So we're, going into 17, having $3.5 million extra above policy is helpful.
Councilmember White?
Thank you. And I would imagine that at least a chunk of that is the surprise. I would imagine it would come out of the rain in Northern California and us being able to buy water substantially more cheaply than we had previously budgeted. So it certainly doesn't account for all of it, but at least it was one chunk of savings that occurred.
Okay, so the next fund we're looking at is the self-insurance fund. And for the CAFR presentation, it's actually combined, in the CAFR report, it's actually combining two funds. So the self-insurance fund and the post-employment benefits fund are actually combined in the report in the CAFR. So the self-insurance trust fund, over the last few years, this has shown a deficit due to higher estimated claim liabilities. So we see at the bottom, the unrestricted, it's in a deficit situation of about $6.5 million at the end of 16. And the OPEB fund, this one was new in, I think, fiscal years prior to 14. All these liabilities for the post-employment benefits were actually spread to all the other funds. And in 14, it was decided to pull them into this internal service fund so we could see what that true liability was for the city in total. And this includes retiree medical, implied subsidy, and sick leave. And as we see here, it's in a deficit of about 17 million. So for a total of about 23.5 million total. The city does plan to put money into the fund to cover the cost for retiree medical and sick leave. However, we do not plan to fund the implied subsidy, and we'll look at that in a subsequent slide as well.
We've talked to you, I think, a few times about the workers' comp situation, just bigger claims, not more claims, but just higher dollar value claims. And the actuaries, every 2 years, they give us a report that says, here's what we think you should sort of have in the bank, almost like a pension. How much money should you have available to pay all these outstanding claims? And they tell us that we should have about 11.8 million. That's that estimated claims payable number of 11,861,000. That's what they say we should have, built up based on the history of our claims and what they expect the future to look like statistically. And we are short. Essentially we're about $6.5 million short. And we're working internally to figure out how we make up for that, because this is going to be a difficult time for us to be raising charges to all the funds to try to recover some of that deficit. But it is a number we're going to eventually have to deal with. We've just had a few bad years. Things could turn around the next few years. We have fewer claims or fewer large claims. We'll have to continue to monitor this.
And Mr. Chair, there was a bulge in the before the crash of money in this account, and that money was used to basically fund operations to help us get over the terrible time. So there had been some good years as far as these claims that we're talking about. So that was a part of the cushion that we used up in order to dig our way out of the crash.
Okay, so next we go into some of the key footnote disclosures. So one of the key areas for the footnote disclosures relates to pensions, and you can find this in it's footnote 9, pages 69 through 80 in the actual report. But the next 3 slides, they're a little bit new this year. We thought it would be helpful to see a 5-year trend in the funding of these plans. So this first slide is specific to the miscellaneous plan. And what we see here is the blue bars represent the actuarial accrued liability. And as you can see, over the last few years, it's gone up. It was going up the first 3 years about 20 to 25 million a year, and then between 14 and 15 you see a little bit bigger bump upward, and that was about 80 million. And what that represented was CalPERS changing their assumptions for mortality rates. They realized that they weren't, retirees were living longer, and they needed to account for that in the plans. So that's what that bump is. And then the orange bar represents the market value of those assets. So what this shows is the funded status from fiscal year 12 through 16. So it's on a steady incline. So it went from about 57, a little less than 57% funded back in 2012 to now almost 74% funded. So that's a good thing. You will notice the last 2 years are a little bit higher than the first 3 years on this chart. And this represents the first 2 years of the 5-year pain plan CalPERS has implemented to get the funds, to get all these plans more fully funded for those unfunded, those prior liabilities that happened back from 2008. So, is there any questions on this one before I move on? Okay, so the next 2 slides are going to be the same setup as this. This one relates to the fire plan, and again, what you see is the same trends. This plan went from 59% funded to about 70% funded, and the bump for the mortality increase in 2015. And fire, the same. So, I'm sorry, police.
I just want to make a comment and back up to the previous slide, because I actually learned this at the COMB did an audit, and they were a lot of focus was placed on the pension issue. But and I'm curious to know how that influences these numbers. So the last 2 years, PERS has made, as I recall, it made 2.8% one year and like 0.8% another. And as a result, and then it isn't as a result, but next they said, well, we're going to raise our anticipated rate of return from 7.5 to 7.65%.
It was my understanding that the change had to do with how they calculate the administrative expenses. So the 7.5 was net of administrative expenses, whereas the 7.65 is not.
Okay, so then the 765, okay. I just thought that might have at least had a twitch, and maybe you can comment to that. Does that influence the net liability? I mean, 0.15%. I know it's one of those things where it's a tiny number, but tiny number over a long period of time gets to be a big number. So does that improve the balance of the net liability?
So just kind of by way of background, PERS assumes a rate of return on its assets of 7.5%. It's, I think what Ms. Tomaszewski was saying is it's really 7.65% because there are costs and fees associated with that, so the net is 7.5%. Okay. But they know that they're not going to get 7.5% every single year. In some years they're going to be up, and some years they're going to be down. They look at 20, 30-year horizons to get to an average of 7.5%. And interestingly and ironically, they have been very successful in doing that over the last, look at the last 30 years. Even with the Great Recession, they've been at 8% or 7.5% overall in terms of rate of return. The problem is that there's been tremendous volatility during that period of time, and that's the issue that they're trying to wrestle with right now. So a 2.5% return this past year, or less than that in the previous year, it's not great because they try to get a 7.5%, but in the context of a 20-year period, as long as they make it up in other years, it sort of all works out.
I hear that. I hadn't, the 7.5 versus 7.65 was, I was unaware of how that occurred. And you're saying that it went from a net to a gross. The 7.65 is a gross,
Yeah.
and the 7.5 is a net of administrative
But the
expense.
working number is 7.5% in terms of what they're really trying to achieve every year and true returns on those assets.
Okay, thank you.
Sure.
Okay, so in line with the pensions, we also wanted to bring to your attention footnote 17, which relates to the OPEB costs, or the OPEB liabilities. So we have 3 liabilities that the city offers, and I'm just going to go through, give a little explanation on each of those. So the retiree medical, based on our actuarial report, the liability for that is about $16.5 million. And what this is the city provides a retiree medical benefit to certain employees who retire and have at least 10 or 15 years of service, depending on which bargaining unit they're in. And then that's calculated based on those years of service by an amount that's specified in each MOU up until the age of 65. So that's the first line. The second one, the implied subsidy, this one's a little bit trickier. In addition to the retiree medical contribution, retirees that are covered under the city plan are also subsidized through this. And this is the cost of the coverage, the rates for medical insurance at a blended premium rate for both active employees and retirees. So because the city has a blended rate, it lowers the rate if the retirees were to have their own rate. So the difference between our blended rate and what their higher rate would be is this implied subsidy. And the liability for that's about $4.6 million. And then the last amount being the sick leave. So the city also provides additional retirement benefits based on accumulated sick leave. And this is only to eligible employees. And I think in the footnote it explains that, but there's a little bit more, there's some factors as to whether an employee terminating would qualify for this sick leave or not. But those that are eligible, their sick leave is converted into a service credit, and then an annuity is calculated based on that service credit and their final average compensation. And the employee can choose to either take a lump sum or to keep that annuity. So the liability for that is estimated from our actuary at about $5.4 million for a total of about $26.5 million.
So this is one of those, at least part of this is kind of a funny liability, and I'll try to explain. So the retiree medical payment is no different than a pension. You know, it's capped at age 65, but we've promised, based on how many years of service and all that, a certain amount of money every month. I don't think it exceeds more than $350 a month for somebody who's been here for many years, up to 30 years. But it's something that we promise to make and to pay when they retire up to age 65. It's, when I look at other agencies who have some, these types of other post-employment benefits, it's much smaller because some agencies provide lifetime medical, full cost, so you can imagine what that would be for the rest of their life, the full cost of medical. So ours is restricted and capped based on how many years of service, and plus it's capped at age 65. But essentially, it's a little pension that we're paying out, and this is the obligation. The implied subsidy, it's one of the strange liabilities because, we provide our retirees the opportunity to participate in our group insurance plan. Therefore, they get a better rate versus being separately rated. And it's something that the council can choose to change any given Tuesday. You might get some resistance, but it's something you can do. There's no contractual obligation. But that $4.6 million isn't really the true cost in any given year between what they would have paid and what they're paying now. It's sort of this weird advanced funding concept that, just like pensions, you want to put money aside every year. So for somebody who's 25 years old, we look at, what's the likelihood they're going to retire and then participate in a group insurance plan. And we're supposed to be putting money aside equal to whatever savings that we would provide them when they retire. It's really an unusual thing and very odd. So that's why, in my opinion, it's an inflated number, and we're not trying to fund that. You know, we're putting money aside for the retiree medical and sick leave, but we're not doing anything with implied subsidy because it's just a strange sort of animal. But GASB thinks that we should be recognizing that liability. And the sick leave is the same thing. It's just not a monthly amount. It's a cash out essentially when somebody retires, but it is an obligation. So I just wanted to give you a little bit more context and perspective to those numbers.
Thank you. Ms. Tomaszewski, go ahead.
And I do have one more slide for you. This is the Streets Infrastructure Pavement Condition Index. And you can find this on, it says page 110 to 11, but I think that's actually went through 112. This is a 5-year trend table showing changes in our PCI rating from 2012 to 2016. The second column, the estimate column, that's the amount it would cost if we were to keep our streets at a condition of 70. Then the expenditures column, this is the amounts we actually paid in each of these years. And the PCI, the last column, is the actual PCI rating. The overall, I'm sorry. So we've established a minimum PCI of 60 being at risk. And as you can see, we are approaching that number now. Public Works staff is currently working to address this issue. We are required to report this because it's a potential unfunded liability to the city, so it's required for our report. So that's all I have. So next I'm going to hand it over to Rich, but before I do...
I think we have some questions just before we transfer to Mr. Kikuchi.
Okay.
Councilmember Dominguez.
On the streets infrastructure slide, the PCI rating, so in the first row, 2011 to 2012, is that 63 at the end of that fiscal year?
Yes.
And I notice it went up
So,
from...
yeah. Oh, you want to go ahead?
So yeah, the going up from 63 to 64 is not that our condition got better. It's that I think Public Works staff started using a different methodology for measuring PCI, and it sort of artificially created a bump. But it's just a different technique and method that's presumably more accurate. But it had caused this to go up, sort of artificially.
And also, just in addition, back in 14, we did also inherit State Route 225, which was relinquished to the city, and it was in excellent condition, good to excellent condition. So I think that was also a contributing factor as well.
And then the 2-point drop, what accounts for that?
The lack of money and spending on streets.
So that was just an across the board. That wasn't one or two streets.
Correct.
Yeah.
I believe Public Works puts a report together. I'm not sure if it's an annual report, if it's every 2 or 3 years. But this is an average of all the streets, is my understanding.
And then I want to go back to the OPEB, slide 28. And looking at the note, there's some assumptions here, the discount rate of 4%. Is that roughly what we've been seeing in the last couple fiscal years?
Committee member Dominguez, no, it's not. It looks at sort of longer term rate of returns. We right now are in the 1 to 2% range in terms of our return on investments, but historically we've been higher than that. So it looks more at a longer term at what kind of return we might be able to get on some of these assets to the extent we accumulate them.
So and these OPEBs, I noticed they mentioned CalPERS in the description, but that's just a triggering. We're not actually putting money into or taking money out of CalPERS for these benefits, correct?
That's true.
So the annual required contribution of $520,000, and this is on page 92. This is what we're collecting from current or from retired participants in OPEB?
This number right here.
Did you say 592?
520?
Okay. So the annual required contribution, this is what the actuaries say we should be putting aside in order to fund the total obligation for that particular liability. So that's what an annual required contribution is. It doesn't mean that's what we're putting aside, but that's what we should be putting aside.
That's the policy guideline.
That's the actually determined amount.
Okay. And so we're not putting that aside?
We're putting aside what's called the ARC for some of those. So I would say for retirement medical and for sick leave, our goal is to put money aside equal to those amounts that are needed. But for the implied subsidy, we're not, as I mentioned, because it's to me it's an odd sort of liability, and we're not attempting to put money aside for that.
So we pull it out of the general fund or reserves?
Yeah, and we basically, it's like an allocated cost. We charge all funds, general fund, enterprise funds, and we pull out their share of that, and then we put it into a separate fund from where we actually pay those amounts.
And the annual amount is roughly the $500,000?
Right.
So the $27,000 amount, this is because it's an accrued amount. This is what we would have to pay if we wanted to settle all of those accounts today. Is this a payout number similar to what CalPERS provides us based on assumptions?
It's the same concept. It's sort of this funding horizon. Along the line, you should be putting money aside, and according to the actuaries, we should have $26.7 or $6 million in the bank today, more than we actually do. And we don't have monies accumulated for any of these things. We're just trying to kind of cover the annual cost. But the unfunded liability, we're not at this point making progress towards that. So that's money we should have in the bank that we don't, as of June 30, 2016.
So when you say should have in the bank but we don't, that would be if we needed to actually pay that all out immediately? Or why would we need that in the bank ever?
Well, ideally we would have the money in the bank. It's just not going to need to be paid out in any particular year because it's paid out over time. So, for example, if we know that we have employees, 100 employees that are receiving a retirement medical payment over the life for up to age 65, that's going to cost X amount of money, and we should have the money to cover that before we start paying it out. That's the idea. We could theoretically release that obligation by giving it all to them, but we would be paying that amount of money over time.
Okay, thank you.
And just one,
Councilmember White has a question.
okay. Well, I was just going to add, this amount currently is not included in the net pension liability that we book on the financial statements. However, effective next year, we will be including that as well.
Well, my question is about the insurance, the health insurance, and I presume that if you work backwards out of this implied subsidy, that the city buys health insurance, and that the cost of that is higher because of this program. And is it higher by this increment? I mean, is it that lockstep
Right.
that it says, okay, if we were just funding healthy young people, then it would have been 20% cheaper, and so that's that 20% that is the implied subsidy?
Yeah, committee member White, what I tried to say this before, that $4.6 million does not represent the difference every year between what we, as a city and its employees, would pay if it weren't for the fact that we have these retirees in the group plan. It's a much smaller number. I don't know what it is, but on a percentage basis, it's small. So it's spread across all employees in the city. Since we have over 1,000 employees, they're paying me, I'm going to make a guess, maybe 5% more than they normally would if we didn't have retirees, whereas retirees are probably getting a 20% savings or more because of that, because there's only a few of them. But that 4.6 represents amount of money that we should be accumulating for current employees who may, when they retire, will benefit from this benefit, if you will. It's really odd.
Thank
you. Are we at that point in the audit results now?
Well, I was going to hand it over to Mr. Kikuchi. I just wanted to say a quick thank you. I just wanted to recognize the accounting team for all their dedication and hard work, blood, sweat, and tears. This report takes months and a lot of long hours to pull together, and we do have a really great team who take it very seriously. So Lynn Sparks, the accounting supervisor, is here. Doug Smith, James Hamilton, Margot Morello, who's new to our team this year. They just put a lot of hard work in, so I just wanted to recognize them. So
Thank you for that. That's very appropriate. This is a
on that
tremendous
note, I
amount
will
of
hand
work.
it over. I can just...
Okay. Good afternoon, members of the committee. My name is Rich Kikuchi, and I'm happy to be here for my annual visit with you all. LSL's been engaged by the city to perform a financial audit, and basically what that means in a nutshell, well, you just heard Jennifer and Bob just share a lot of financial information with you, and if you got a chance to read this document, there's just a lot of information in there. And it's all a summary of what's on the city's books. And as Jennifer mentioned a couple times, and Bob too, that information needs to be summarized in a prescribed format to follow GASB standards, to follow GAAP, in order to receive the GFOA award. And so, the city's been very, very diligent, and they're very capable of putting this document together. And what my role is to basically double check it. Is to basically go in and test account balances to make sure that those amounts are materially correct in these financial statements, and then also to step back to look at the processes that are here at the city so that I would be comfortable in recognizing that the financial transactions are being summarized properly, because there's just a lot of information going on, and you're all different funds, different types of funds. Your enterprise funds require depreciation calculation. Your governmental funds, that are basically on the cash basis. So there's just a lot of different types of methodologies going on. So my role as your financial auditor is to make sure that the systems that are in place are good systems, and that the amounts in these financial statements are materially correct. And that's what our firm specializes in. Our firm's been around since 1929. We specialize in auditing cities. We're known in the state of California as being the premier firms auditing primarily mid-sized and large-sized cities. So we do this all year round, and Santa Barbara's been just an outstanding example of how the financial operations should be conducted. So the audit went well, and let's see, how do we go there? So the audit process is a fairly in-depth process. Bob mentioned it started in July, and last July, and so we're always kind of working back in history. But we came out here in the month of May, and at that time, it really was that first time that we came out to make sure that the system that is in place here at the city is accurately summarizing financial information, and that also there are safeguards in place. And so we spent a lot of time out here. We planned the audit during that time. We asked a lot of questions to a lot of different people, not only in finance but throughout the city. And at that time, really looking at the internal controls. And then we came back out in September, and that was the time that we really kind of dove in and worked with Jennifer and Bob's team in helping to get this put together. And that required doing a lot of account analysis. We talked about your net pension liability. That really is something that we really tried our best to get our arms around the last couple of years. It's really a beast. So we spent a lot of time on that GASB 68 calculation. Also things like your cash and investments, receivables, payables, capital assets, all those, particularly the large account large accounts that are represented in this CAFR, we spent a lot of time on. And Jennifer mentioned the three primary sections in this CAFR, and the financial section really is the part that we spend the most time on and that we render an opinion on. And so, as I mentioned, City of Santa Barbara has a lot going on. You're a full-service city. You have you name it, you have it going on. So as your auditors, we come in a few weeks out of the year. Because we specialize in cities, we have an approach, and we know the things to look at, but we really can't look at everything. There's just no way, or else I'd be here more than once a year talking to you guys. But we look at the transactions to a degree that we are able to obtain what's called reasonable assurance that the amounts in here we feel are materially correct. You guys are using this document in order to make management decisions. This document will be a part of the process has been a part of the process to plan for future events and future budgets and such. And so, that reasonable assurance is something that auditors abide by, and I need to conduct enough test work that I feel that the amounts in here are materially correct. Maybe not every single dollar, but it's really close. But if it wasn't, I would let you know. But the audit went well, and the results. My main product that's in here is the auditor's opinion. The city really put everything else together, all 3 sections, everything else in there. And as your financial auditors, we come in and basically double check it and make sure that, we feel that those numbers are correct. But we do enough work so that I could render an opinion of how I feel about these statements. And so we've issued what's called an unmodified opinion. That terminology changed a couple of years ago, but unmodified that's the highest level of assurance that you can put on financial statements. It's saying that, I haven't needed to modify my opinion in regards to this document based on my test work. So that's what you want. Unmodified is definitely what you want. In regards to the audit, I mentioned we not only look at accounts, but we look at controls throughout the city. So every year, there's basically 3 products that we issue to you and we actually address to you. Number 1 is that auditor's opinion letter that's within this document, and that's, like I mentioned, I've issued an unmodified opinion. There's also 2 other letters that I always publish for you. The first one is the SAS 115 or internal control letter, and the second one is the audit communication letter. In that SAS 115 letter, if there's anything that came about that I need to report to you based on our test work, that's the letter I will put it in. There's certain guidelines of things that I'm required to put in there. In the past, routine items like if we made a journal entry based on our test work, we wouldn't put that in there. But now we're required to do that if it's a quote-unquote a material item. This year there was one item in there that we needed to report to you. However, it really was of minimal consequence, but we need to put it in there. What we do every year is we take a look at the checks that were written after July 1, after the fiscal year end, and we look at what those checks were written for, either services rendered or goods received, and we'll see, was it recorded in the proper period? Should it have been recorded in the prior period, or should it accurately be in the current period? There was one item that we noted that really needed an adjustment. With a city this large, it's I'm thinking it should happen more often, but so there was one item that we saw that we needed an adjustment. Not a big deal, but we put that in there for you in case you saw that. And then in the audit communication letter, that's a little more standard in there. It's really a step 2 to the SAS 114 letter that we issued at the very beginning of the year, which requires that we have dialogue, which is great that I'm here, that we're able to talk about the audit. The auditor's communication letter, if there were any disagreements with management during the audit, I would need to report that to you, and there were no disagreements there. We also talk about new pronouncements that have been incorporated into the current audit, and also pronouncements that are going to be upcoming that are around the corner, and so we put those in there. There's also a new auditing standard effective for fiscal years ending after December 15, 2016. It's called SAS 130. I think a lot of cities will be taking part in that. What that really means is, and I've mentioned this to you every year, I'm auditing these financial statements, and I issue a letter to you. We look at controls, but we don't necessarily audit your internal controls. We need to determine that controls are in place, but we don't really audit them. SAS 130 just came out, and so that gives auditors direction, and it's an optional audit for the cities to incorporate a SAS 130 audit, and it's entitled An Audit of Controls or Financial Reporting Integrated with a Financial Audit. And so basically that's saying, we would do extra work in order to render an opinion on not only your financial statements, but also the internal controls of the city. So that's something that's not effective until this next year. But, those are the kinds of information that we put in that letter. So, basically, all in all, everything that we did was in order that this would be a sound document, a document that you can make management decisions on. And then also, we're issuing it for the GFOA award, which was the 13th year, you said? This will be 14th year. Yeah, 14th year. So, we need to abide by and follow certain reporting formats. I'm actually on the GFOA technical committee, so I actually review CAFRs from across the country. So, I'm going to make sure that you guys are following those procedures. So, Jennifer was right. It was a lot of work to get this document done, but in summary, LSL's been engaged to do a financial audit. The ultimate result of that is issuing an opinion, which I did in this letter, and it's an unmodified opinion, which is the highest level you can receive. Issued 2 other letters, and we're expecting to get the number 14th award here pretty soon. So, like Jennifer, I just want to thank Santa Barbara Finance Department team. Just an outstanding group, always wanting to do things the right way, and they're just very top-notch. They're a joy to work with, and I thank you for inviting me here, and I'm here to answer any questions if you might have any.
Thank you, Mr. Kikuchi. It's nice to hear from somebody who isn't part of the city family that our staff is as excellent as we know they are, and it's great to have your independent review of that, and thank you for your work.
Thank you.
Councilmember Dominguez?
Again, thank you for the work on this. How long have you been doing this audit for the city?
We're in our 3rd year of a 3rd-year contract. This is the second 3-year contract. Yeah, so the 6th year.
And what's the standard frequency that we refresh with audits, or cities refresh with a new set of eyes?
We currently have about 65 cities that we audit. I think my average tenure with my clients is 10 to 15 years. But there was a new AB 1345 came out 2 years ago, and it requires after fiscal year ending 2019, after 19, then it says that you should rotate firms or you should rotate the partner every 5 years. So, that's going to be effective in 3 years.
Okay.
Yeah.
And so there's 3 letters we have in front of us. Which one is the SAS? I think, what was the number you mentioned?
114?
Correct. One of the 2 loose ones?
Okay. And that really is the second part of the 114. It's
So which one is it? Is it the one that has one of them has a title, one doesn't? One's dated November 29th.
Yeah.
So this is the SAS.
So in there, like if you look throughout, I'll be talking about.
You'll need to get on the microphone, unfortunately, because we're on TV.
Is this one of the SAS numbers?
You could call that the SAS 114. It's actually the second part of the 114 letter. There's another 114 letter that we issued in the springtime. That's actually the part one of that letter.
That was in May.
Yes.
And then the other two letters, there's another loose one, the independent auditor's report on compliance.
Yeah, that's the SAS 115. That's the internal control letter.
So it talks about something with the housing successor. And what was the gist of this opinion?
Oh, is that the housing? Oh, okay. So that's even another. Yeah, that's compliance with the housing successors.
So it says there's a material weakness in internal control. Or what's the result of this?
I think Lynn, is that I believe that's another copy of the one that's bound in the report. I'm looking at on compliance. Oh no, that is related.
Yeah,
One in the report seems to explain that there was an invoice that was paid late or outside of the fiscal
Yeah,
year.
that's the 115 letter. That's not in that one though.
So if the report on internal control citywide is bound in this document, so it's the very end, the very last page. This one you're looking at relates to internal
You're
control.
talking about page 188 and 187?
Yes.
That looks like it's talking about one material invoice related to fiscal year.
And that's what Mr. Kikuchi mentioned about the one invoice that was not charged the right year. This loose letter relates to the successor agency, and there's a separate report required for that. Just like we used to for the RDA, we issue a separate report. There was no material weakness that I can see. It's just defining what a material weakness is if they were to find one.
Can you hand that back so I can ask further? So these letters are issued as a matter of course when there's a successor agency. So this is just a routine audit.
It is.
Okay.
It is. Actually, cities have the option, if the housing successor is what's called a major fund, you could leave it in here, and it has to be posted onto your website by December 31st. Most of my clients would like a separate report, and then it's posted to just abide by the requirements of the state.
So this language about a deficiency in internal control, material weakness, this is just boilerplate.
Yeah,
if there were to be one, it would define it?
Exactly.
Okay.
Yeah, if there was one, it would be separately called out.
Just wanted to make sure I didn't miss
Yeah.
any potential bad news. And then the other letter, the November 29th, it talks about a misstatement described in a separate letter dated November 29th. That's the one in the book?
Yes. Yes.
Okay. Thank you.
Okay, if there aren't any other questions, I think we're adjourned.
Thank you.
Thank you.